Hello everyone. In this video, we are going to talk about one of the most important strategy that we use in scalping, that is open high strategy. Many of you actually asked me about this strategy, so I thought of doing this video. See, the open high strategy is a very fascinating and a systematic approach for traders who are looking to capitalize on market movements in index options. So first, let me tell you that we will be using this in index options. We use this in Bank Nifty, Nifty, and for that matter, we can use this in index option. You can try whatever I'm going to discuss in stock options, but I have not tried, so I'm not sure about stock options. And it is very much clearly designed for precision, and it is actually supported by the data. Okay, so if you look at the previous data, that also, if possible, I'll be showing you. It is clearly supported by the data, and this strategy allow the traders to identify the potential trends at the market's opening itself. So there are a lot of controversies related to this concept. So when I say open high, open equal to high means right at the open is the high price. What does that mean? Many will be thinking that from there the sell-off have started, right? That's why opening itself is the high. From there, it never made a new high. So it is like a bearish outlook. But here I'll be discussing in an entirely different perspective. Understand this and watch the market for a few days and then see if it is working out or not. But the data suggests whatever I'm going to discuss here is what higher probable. Okay, so this is a setup with 75 to 80% probability. So let's discuss, and that too the probability is taken with ITM and ATM strikes. If you go for OTM strikes, that probability won't be there. It will be even less than 50. OTM means itself is the probability is less. Okay, so here in this session we will discuss how open high strategy work and when to trade it and what makes it a high probability trading tool for you in the future. So let's simplify this concept and see how it can be your next winning strategy. Remember, many have this perception that open high means opening is the high, that means it is bearish. Similarly, open low means low is made at the opening and then it is going to be bullish, right? But I'm going to demystifying that, and then let's see in a different perspective. See guys, first let's try to understand the term open high. It refers to the scenarios where the opening price of a particular strike price is the highest price of the day. So here I'm not talking about futures, I'm not talking about spot, I'm talking about the strike prices. And I'm talking specifically about ATM and ITM strike prices, not for ITM, couple of strikes ITM, okay? And this occurrence basically often indicates significant activity by some big players, the major players in the market. That is potentially signaling their directional bias. So someone want to take market on one particular direction. For example, it's a strategy that identify opportunities based on how the market opens and react on to that day's initial price action. So that's what it actually tell you. So open high, it is going to tell you how is the initial price action. Now let's see, let's try to understand how open high is created. See, this open high setups are typically created by large institutional players. If you take an example, a big player, someone, any institutional player want to deploy, let's say 100 crore in a bullish side of the market. So his outlook is bullish. So his directional bias is bullish. He want to take the market higher. So instead of investing, all money at once, what they do, they allocate, let's say 20 crore across different categories. So it could be including futures. So he will buy some futures and some will be at the money, some will be ITM and some will be OTM. So he will be buying calls, he will be selling puts, he will be buying futures. Okay, so this is how it will be deployed. So initially he will deploy some and then later we'll add more like that. Okay, so this initial deployment triggers large market orders at the open. So when large market orders triggered at the opening itself, you're simply punching a market order. So what will happen? The price will be taken at whatever is the market demand, right? So it is what is the equilibrium at that point of time, whatever is the market demand. So they are punching the market order. So at the high itself, it get triggered. So much of orders also will be there. So that's how the day's highest price is created. Subsequently, the price will come down. So price will drop and then it will settle. So allow these players to gradually deploy the remaining capital. So at the opening, they will aggressively buy some at the market price, and then when the price settle down, keep adding. So that will align with their directional intent. Now what will happen? So what will happen is After some time, they'll take the market higher. But will you be just by seeing an open high, will you be trading that? No. What you will be doing is you will be looking at, let them go down. If the price is going down, it's okay. Let it go down. This is a probability that we are not going to trade. This is a lower probability. Once the price comes above VWAP for any that particular strike price, okay. So as long as the price is trading below the VWAP, we are not interested. If the open high is above VWAP, and the price coming above VWAP, that's when you will be trying to capture that open high move. Okay, so see, there are specific conditions that we need to look for. First thing, you focus on, 1 or 2 ITM, or maybe 40 delta also you can go. 40, 50, 60 deltas. These are what typically you can focus. So one step ITM, one step OTM, and ATM is preferred. So avoid deep ITM, avoid, OTM also beyond 40. So as they're less reliable, basically, ITM, too much fluctuation will be there. OTM, the chances of coming up is so less because of the time decay. So if you combine this open high with open low data also, for example, if open high occurs on call side, and if open low present in the corresponding put option, that is going to give you more probability. So one more thing that you need to focus is try to trade this open high strategy before 11 a.m. So during this time, the likelihood of successful will be the trade becomes successful will be more. The probability is more. After that, the time decay and everything will get affected, and we are looking for the strike price, right? Now, when you're trading, just because the price is dropping is not an entry, right? You saw the open high, that is not an entry. Price is going down, that's not an entry. Don't think that you're going to get it at a lower price. Whenever the price either cross 9 EMA from the bottom, or 20 EMA will be better, or VWAP. So 20 EMA and VWAP, if the price is crossed and there is some distance between that VWAP and the open high, that is where you're actually going to enter, and you won't be staying there also for a long period of time. Okay, so that's how you will be taking the trade. Whenever the price of the strike price goes above VWAP, that's when you will try to capture that open high move. So again, guys, again, market context is also very important. If it is a bearish market, and then you are not going to try for that. Okay, if everything else is looking bearish, and then you are not going to try for a bullish trade, they are also wrong, or some other player might be pumping more money on the other direction. So I'm talking about strike price. It could be on the call side, it could be on the put side open high. But I'm saying, if you are trying to go for a bullish trade, call side open high, but it is clear that the market direction is downside, because some other player might have had more funds and they are pushing the market down. So don't rely on this in that situation. So success with open high depends on aligning the strategy with broader market conditions. That's why I told you, as long as price is below VWAP, it is bearish. So don't look for a bullish trade. As long as the price is below 20 EMA, it is bearish. So you won't look for a bullish trade. So market trend is going to be very important. How can you identify the market trend? Use super trend, use VWAP, use 20 EMA. You can easily identify the market trend. VIX is again a very important factor. Rising VIX actually suggests increased uncertainty, which can again affect the probability. So probability and everything is what we are looking at, right? So rising VIX is again going to affect the probability. It is going to affect the IV and everything. So that's again, we need to align with, again, global market condition is very important. So you need to keep an eye on the global cues that might influence the index movements. See, for instance, if the market is falling and VIX is rising and open high appears on the call side, then what you will do, the trade may have a lower chance of success, because VIX is rising, market is also falling. Market is falling, VIX is rising, clearly showing uncertainty. It indicates that the market may go down further, but your open high is on the call side. So in this situation, market trend is against you, so you are not going to take that trade. So I hope that clear. So open high strategy we are going to use based on the broad. If that open high is on the put side, that it won't happen in this case, because market is already falling, open high wouldn't have created, right? So in that case, we'll definitely go for put side. Now, certain rules that you need to focus to maximize your success rate and the probability. Always consider, as I told you, open low alongside open high for confirmation. So let's say, as I discussed before, if put side is your open high, look at the call side whether there is an open low. If call side is your open high, look at the put side if there is an open low. So that, correlation, if you can match, that is one very good probability that you can look for. Again, avoid trades after 11 a.m. I told you after 11 to 1, that's 1:32. That is a time where maximum time decay will be there. So we are not going to subject to or exposed to that time decay. That again will affect the probability. Again, integrate the market analysis, market conditions, as I discussed before. Look at the chart, look at the global factors, look at the global cues and influences into your decision making. Just by seeing that open high, you cannot take the trade. So see this, treat the strategy as a tool for index option. Again, don't try to test too much for stock option. It can be tested from your side, but results may vary. But index option, it has been tested, it has been proved that it is having more than 75% probability. So guys, let me conclude. The open high strategy is a very powerful tool for traders who are seeking consistency and reliability in index option, given the fact that it is having 75 to 80% probability, as I've discussed. So by combining data, market analysis, time, I told you, the disciplinary execution, that is ultimately what matters. You can turn the strategy into a significant edge in your trading journey, and it can eventually become a money making machine, an ATM counter itself. Okay. So again, remember, the key lies in understanding the market dynamics and changing based on that. So let's say if the open high is on the call side and you understand the market condition is on the put side, you are not going to chase that. Okay. So always stick to the rules, and that's when you will be successful. That's about the session. I hope you got some knowledge. Thank you so much for watching.